Nam-Yong's editorial, Long, a warning to the Republic of Korea's economic security from the $350 billion investment commitment by January 19, 2029, under the Korea-US Memorandum of Understanding, MoU, tariff and investment negotiations between nations are never mere diplomatic events. They are macroeconomic developments capable of simultaneously shaking currency values, financial markets, industrial competitiveness, and the real income of citizens. Contrary to the market's general expectation of $20 billion annually for 10 years, if the MoU contains a structure stating that investment commitments shall be made on an ongoing basis from the date of this memorandum until January 19, 2029, it implies an entirely different risk profile. If the timeline is compressed from 10 years to effectively about 3 years, the foreign exchange market interprets it as a clock for short-term dollar demand. Exchange rates respond first not to numbers but to time structures. An even more critical clause states that there is no obligation to liquidate or dispose of the investment by a specific date. This can function as a stabilizing device because it does not force abrupt capital withdrawal. At the same time, however, it implies that large-scale investment execution may continue over a defined period, thereby generating structural dollar demand. The foreign exchange market reflects this duality directly in pricing. The core risk, therefore, lies not in the investment itself, but in the speed of execution and the method of funding. Without understanding the global standard of international negotiations, this issue cannot be properly assessed. Typically, Korea-US tariff and investment negotiations proceed through 3 stages: Letter of Intent, LOI, Memorandum of Understanding, MoU, and Memorandum of Agreement, MoA. The LOI represents the stage of expressed intent. While legally limited in binding force, it signals policy direction to the market. The MoU constitutes the stage of principled agreement, defining the scope of cooperation and foundational conditions. The MoA is the execution stage, effectively functioning as an operational contract in which responsibilities and timelines are specified. These 3 stages represent the international standard and cannot be ignored. The foreign exchange market translates the pace of progress in these documents into a timeline of dollar flows. At the LOI stage, expectations begin to move. At the MoU stage, risk premiums are adjusted. By the MoA stage, actual capital flows become embedded in pricing. If a government fails to sufficiently explain the differences in risk between stages or does not clearly present the timeline structure, the market adopts the most conservative scenario. As a result, an upward premium is consistently attached to the exchange rate. Exchange rates are composites of real flows, expectations, and policy credibility. The Republic of Korea's foreign exchange reserves are estimated at approximately $420 billion, yet this does not represent cash that can be mobilized immediately in its entirety. Liquidity composition and maturity structures impose constraints, and usability varies depending on market conditions. Ultimately, what the market evaluates is not the size of the number, but whether it can be deployed when needed. Foreign exchange reserves are both an economic asset and a psychological asset. A relational approach requires identifying stakeholders first. The United States government holds tariff authority and occupies a strategic position capable of pressuring investment implementation. The Korean government and monetary authorities bear overlapping responsibilities for exchange rate stability and inflation management. Korean corporations are the primary executors of investment, and their funding choices determine actual dollar demand. Institutional investors, such as the National Pension Service, expand overseas investments, thereby forming structural dollar demand. The foreign exchange market prices the imbalance among all these relationships. When the relationships among these 5 groups are stably designed, the exchange rate finds order. However, if policy messages waver or negotiation structures lack transparency, the market immediately applies a discount to the Korean won. A sharp rise in the exchange rate is not merely a financial event, it directly impacts citizens' livelihoods through higher import prices and upward pressure on interest rates. Failure in exchange rate management therefore translates directly into risks to public welfare. Consider first the channel of real dollar demand. If investment commitments are made on a rolling basis, continuous demand for dollars emerges. This creates a moderate yet structural depreciation pressure on the Korean won. In the expectations channel, reactions occur even faster. The moment the interpretation spreads that the investment timeline has been compressed, the exchange rate rises before any actual capital movement occurs. The foreign exchange market always front-loads the future. The trade and tariff channel may exert force in the opposite direction. If investment commitments are linked to tariff stabilization, improved export prospects could increase dollar inflows. In particular, if export cycles in semiconductors and advanced industries remain strong, much of the upward pressure on the exchange rate could be offset. Ultimately, the exchange rate is determined by the balance between investment-driven dollar demand and export-generated dollar supply. The policy operations channel is the decisive battlefield. Direct, large-scale dollar purchases in the domestic spot market immediately generate upward pressure on the exchange rate. Conversely, utilizing local borrowing, project financing, dollar-denominated bond issuance, currency swaps, and forward hedging can structurally reduce shocks. Modern macroeconomic management is not about declarations, it is about financial engineering. 3 scenarios are possible. The first is managed and distributed execution. If funding is structured and policy communication remains transparent, the exchange rate is likely to remain stable within a range of gradual upward pressure. The second is a negotiation shock scenario. Should tariff conflicts or disputes over implementation arise, risk premiums could surge, causing the $1 rate to spike in the short term. The third is an export boom scenario. If technological industry growth aligns with a global economic recovery, Korean won appreciation is also conceivable. At this juncture, criticism of the current government cannot be avoided. If a foreign investment commitment, one of the core variables of the national economy, has been left open to interpretations that diverge from market expectations, this constitutes a failure in policy design and communication. If the structure and timeline of the negotiation stages have not been clearly explained to the public, economic governance has already revealed cracks. Economic policy must be designed not on optimism but on worst-case scenarios. A compressed investment timeline can send unnecessary signals of tension to the foreign exchange market. If the government merely repeats that there is no problem, the market will demand an even greater premium. Trust emerges from explanation, and explanation must come through numbers and schedules. Economies are not operated through political slogans. The current administration must recognize a fundamental reality. Exchange rate instability is a direct burden on the public. A weaker one leads to higher import prices for energy and food, thereby reducing real wages. Upward pressure on interest rates increases the burden of household debt. Ultimately, failure in foreign exchange policy delivers a direct shock to the national economy. What is required is unmistakably clear. Investment schedules, funding methods, hedging strategies, and foreign exchange stabilization mechanisms must be disclosed in numerical terms. The precise stage of negotiations must be transparently revealed. The moment a vacuum is left in the market, the exchange rate rises by exactly that magnitude. The engineering principles for defending the exchange rate are equally clear. Direct spot dollar purchases must be minimized. Investment execution should be precisely matched with the calendar of export dollar inflows. Derivatives must be utilized to manage expectations proactively. Policy information should be disclosed regularly. Foreign exchange reserves must be operated as assets of credibility. From the perspective of Federal Enterprise Architecture, FEA, this issue does not end with foreign exchange policy alone. It is a matter of national operating systems in which economic management, financial management, international cooperation, and financial supervision must function simultaneously. Without data-driven governance, the market discounts policy capability itself. Advanced nations do not block crises with money, they block them with structure. The conclusion is clear. The large-scale investment commitment extending to January 19, 2029 is likely to exert baseline upward pressure on the $1 exchange rate. The true danger, however, lies not in the investment itself, but in the erosion of policy credibility. A national economy is not safeguarded by optimism, it is protected through precise design and transparent explanation. There is only one task the government must accomplish now: honor the investment commitment while ensuring that the exchange rate does not destabilize. That capability is the true measure of a nation's economic strength. Thank you for watching Nam-Yong's editorial, Long.